Hey, what's up, everyone? My name is Ale. Welcome back to my world of stocks. We've got actually one of my favorite yearly videos for you guys today, where I give you my absolute favorite dividend stocks at the current moment at today's prices for 2025 and beyond for the long term. And to give you a little more variety, I specifically chose two lower risk, two medium risk, and two higher risk options for some added variety, and that makes up 6 awesome dividend stocks in total that I can't wait to share with you guys. Now, of course, this is all just my own opinion, so as always, please do your own research and make your own decisions. But if you appreciate a video like this and you want a part 2 where I give you maybe some bonus dividend stocks to consider, then please hit that like button and subscribe. Those two things really help keep my channel alive, and it lets me know you guys want a part 2 with some bonus dividend stocks. But with that said, we got to start here with my top 6 favorite as of right now. So let's just go ahead and jump straight into my list. All right, now we'll be starting first here with our 2 lower risk options. And for the first one, well, I'm going to go with, I got to go really 100% with the dividend stock that I've been buying the most of recently myself, and that is a REIT known as Vici Properties, ticker symbol VICI, which I can explain my case for very simply. Now, reason number 1, the business is fantastic. For being a REIT, it's probably as good of a real estate business that you could really hope for, because they own close to 100 properties in North America, with their biggest tenants being gaming and entertainment clients, including most of the top casino resorts in Vegas like Caesars, MGM, and more. Now, these are massive gambling and casino businesses that are just about as sticky as you can get too. They're pretty resilient to recessions. They generally sign multi-decade contracts with the REITs, and because of their massive size, along with strict gambling regulations, well, it's extremely hard for any of them to really relocate. And thus, it gives Vici not only a wide moat, but also some of the highest occupancy and rent collection rates in the world. In fact, during the 2020 pandemic, when much of the Vegas Strip was even closed down, well, Vici was one of the few REITs out there to still bring in 100% of their rent during the entire time, the entire pandemic. Now, reason number 2, interest rates are coming down. That's going to make it really where these big dividend paying REITs like Vici become more valuable to investors, because sinking rates will make it cheaper for the company to acquire more real estate and expand, thus helping them grow, while also making their high dividend yields more attractive to income seeking investors because of other assets offering really lower rates and yields by comparison. And yet, reason number 3, a recent dip has actually left the stock down about 17% from the top, leaving behind a mouth-watering dividend yield of close to 6%. Now, I'm absolutely loving the stock at these levels, and I continue to be a buyer myself for the long term. But moving on here to the second low risk option, well, this one I think I can make just about as easy of a case for too, and that is the medical devices giant Medtronic, MDT, another stock that I love here. I've also been a heavy buyer of this one these past couple years, really ever since the pandemic crash that sent the stock falling around 40%. The theory being that, kind of during that time, around, those couple years, because so many people were staying home and avoiding medical procedures, along with the deteriorating economy over time, sky high inflation, interest rates, all that kind of stuff, well, Medtronic would have a really hard time selling all of their medical products and services to hospitals that are already struggling, which there is obviously some truth to that, as their sales and profits dipped a couple times during these recent years. However, longer term, this is not really a valid reason, in my opinion, to avoid what is literally the world leader in medical devices, as the pandemic has already dissipated, with interest rates now coming down to help recover the economy, and people are largely getting back to having all of their regular procedures, all that kind of stuff done again, with hospitals back up and running to their typically normal rates. And as such, so too are Medtronic's financials recovering once again, yet the stock price continues to trade dirt cheap regardless, at about 30% cheaper than the sector on a forward PE basis, with the dividend rising to about a 3.5% yield with nearly 5 decades of consecutive growth. They'll even be considered a dividend king soon. And so I just think that this is not a stock to treat lightly on any dips. It's a world leader that's been around for over, I think it's over 3/4 of a century. I mean, they've been around around for a long time. They've got an incredibly strong track record of success. And they even have some future growth opportunities to get excited about too, like in medical robotics. So I love the stock right here, and I continue to be a heavy buyer myself. All right, guys, it's time now though to switch over to the two medium risk options. And for the first of those, I'd actually say that it's pretty low risk overall. I kind of just had to bump it down here for the space and the categorizing, but you'll see what I mean here. I'm going with what is actually my second favorite overall REIT at the moment, only behind Vici. That is Extra Space Storage, ticker symbol EXR, who may not have quite as strong numbers as Vici. I think a lot of people would maybe argue a little bit back and forth as to which one is a little stronger or maybe a little lower risk. But regardless, in my view, I think EXR is just about as close as you can get to the quality of Vici for being another REIT in terms of also having an incredibly strong business that has at least some protection from a recession and interest rates and inflation, and also with just a general rise in online trends like e-commerce and remote work. Those are really two things, guys, that generally devastate REITs who hold properties in areas of retail and business, because those tenants tend to transition over time to digital options instead, leaving these REITs with large properties that they struggle to rent out and may even have to sell off in the future. However, that's not the case for EXR, who is actually the largest owner of self-storage units in America across more than 40 different states, with also still a ton of room for acquisitions and expansion given the rise in demand, which you can see on this chart here for storage units. Again, it's in large part because of actually the rise in e-commerce, remote work, and similar trends that people and businesses will turn to self-storage facilities to keep a lot of their equipment and other assets, but also just people in general. Even in times of economic hardship, they may downgrade their house or apartment, just put a lot of their stuff in storage facilities instead, maybe take on roommates and all that kind of stuff. Anyway, I just don't ever really see the demand. The point being, I don't see the demand for storage facilities ever going away at all. I think it's going to rise actually. And that's resulted in really strong occupancy rates above 90% with equally strong financials year after year for the company, which is also why self-storage REITs in particular typically outperform virtually all other types of REITs in the market. And I just think EXR is the best one in terms of size, their portfolio, how well it's run, and even their balance sheet. But yet, because of rising interest rates in recent years, the stock has actually lost over a third of its value from the top, raising the dividend yield up to over 4.4%, which is also among the highest levels it's ever been. So right here, I just think it's way too attractive to ignore. I'll continue to be a buyer myself into the new year. All right, guys, this next one though does actually raise the risk a little bit more here. For medium option number 2, I'm going with the telecom giant Verizon, ticker symbol VZ. And look, here where really the bulk of the risk comes from is in their low growth because of how well established the giant telecom market already is, the limitations of how much you can still grow there, which is a bit of a hard pill to swallow for investors when the company has had to make such large investments spend so heavily into fiber and 5G technologies that has ballooned their debt levels to really scary heights. All of that is true for Verizon, but it's also the reason why I think that we're left now with really an incredibly cheap value and high yielding dividend stock with the price falling by over a third of its value from the top to now one of the absolute lowest prices of the past decade, which lowered the valuation to around 30 to 50% cheaper than the sector, while also raising the dividend yield up to almost 7%. That's among the highest that it's ever been. So you could say that it's almost like buying or being able to buy Verizon stock at around the same type of valuation and dividend level as it really was like all the way back in the Great Recession, which is kind of incredible. And yet, what's happened since then? During that time, well, Verizon has actually grown into basically the largest telecom provider in America with by far the highest quality of service awards. Nobody even comes close. They've won like over 30 JD Power Awards in a row. Again, nobody even remotely close to that. And they generate more sales than the other two biggest players in AT&T and T-Mobile, yet they have a cheaper valuation than them, a bigger dividend, while still generating plenty of cash flow to help pay down their debts over time. I calculated like over $6 billion just in the first 3 quarters of the past year, even after subtracting for dividends. So while it is a stock to be cautious of, and I certainly don't want to be overexposed to it, I also think that it's just too attractive at these levels to not be buying more in the coming year. All right, it's time now to finish up, guys, with the 2 high risk options. So it'll be interesting to look at. For the first of those, I'm actually going to go with a stock here that, just a while ago, I would have never thought of this one as high risk. And that's because this is the largest pharmaceutical company in the entire world, in Pfizer, ticker symbol PFE, who's now seen their stock price lose over half of its entire value from the top and even fall by double digits over the past 10 years to now the lowest prices of the past decade. And that right there is why I consider it high risk, because no matter how much I say that this is an incredibly cheap value stock with an incredible dividend, the market just continues to sell it off regardless, which I've argued likely has to do with a couple things. Really, the deteriorating sales of the V shot, moving past the pandemic, and now also a Trump presidency with Kennedy leading the HHS that some worry could pose problems to giant pharmaceutical companies like Pfizer. But to those 2 points, number one, I don't think that they need the pandemic V shot anymore because they already made a fortune off of it and have so far spent like over $70 billion from it to acquire several other large biotech companies to fuel future growth. And for point number two, I actually think the Kennedy appointment will focus more on getting cleaner ingredients into people's diets rather than completely collapsing the giant pharmaceutical industry that, let's be honest, is not likely to ever go away because of how large and powerful it is. But in the meantime, this is, the largest biotech that we have out here. I know it's a controversial one. Some people like them, some people hate them. But from a stock investment perspective alone, they now trade around 50% cheaper than the sector, with also a dividend yield at one of the highest levels we've ever seen of it, of more than 6.5%. So for as much as it keeps falling, I can't help but be a buyer at these levels. Now, finally, I'll just throw one more stock at you guys. That'll be Tyson Foods, ticker symbol TSN. And this is a stock that surprisingly doesn't get talked about very much. I actually don't think I've ever really seen anyone else bring it up, but I do think that it's one worth considering, especially as the world leader in meat and poultry, a massive market that I don't ever see going away with some of the really biggest brands in the space. And even if you think that future growth will be more so in plant-based alternatives, for example, well, they also offer that too, as well as venturing into other growth opportunities in frozen, air-fried, and other quickly prepared meals that I think will keep rising in demand with really how busy people's lifestyles have become these days. However, the risk really comes in from just their overall exposure to the macroeconomy, which has been decimated in recent years with crazy high inflation, rising input costs, with high interest rates to combat it, all of which temporarily has hurt Tyson's profitability. But I just think that those are issues that always kind of tend to come and go, while Tyson's business has mostly been resilient and is likely here to stay. At least that's what I would argue, which is why anytime that the stock has traded within this $50 range that it's currently in right now, well, those ultimately prove to be really big buying opportunities. And I expect this one to be no different. I could be wrong, of course, but with the valuation now trading 62% cheaper than the sector with a PEG of less than 1, and the dividend also climbing to one of the highest levels that it's been at that we've seen from them, even more than where they were at during the Great Recession, well, I just think that it's worth betting on at these levels. At about a 3.5% yield, it is one of the, I think it's the smallest dividend of today's list, but I just feel that the overall package for Tyson Food stock is still extremely attractive. Anyway, that'll do it for my list here to kick off 2025. What do you guys think? I'd love to hear your thoughts. Do you agree with my picks? Are there any other dividend stocks that you think I should have included instead? Let me know down below. I may include them in a part 2 where I give you some bonus dividend stocks. I'll keep it in mind. I'll give some thought to it, some consideration. Anyway, thank you, my friends, for all your support. If you do want to go above and beyond, you can support me on Patreon. Link is in the description. That also gives you access to our community Discord, where you can reach me anytime and the community. And it also gives you access to my daily stock trade, where I post a new stock purchase every single day on there. You can get that in the description. But thank you for just watching the videos. It means the world to me, guys. Thank you for all your support. I love you guys. I hope you're all doing well. And yeah, let me know if you need any help out there, but I will catch you guys in the next one. Take care, my friends. Bye-bye.